Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility, and although this could be an equation for opportunity, it's also an equation for risk. So be careful, only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Good afternoon and good evening. Welcome to Traders Workshop for Tuesday, January 30th. I'll be your host, Tom Schneider, CMT. And on Traders Workshop, we like to bring in our NinjaTrader Ecosystem partners to talk about their expertise, to show you, the trader, what they can do to help you with your trading. And today is no different. We have a return guest, and it's my pleasure to bring back the founder of Traddictiv, Jose Blasco. How you doing, Jose?
Hi, Tom. Hi, everyone. Pleasure to be back. I'm doing very well. Thank you so much.
Oh, it's great to see you, Jose, and we love having you on here. It's great to have you back. How's the 2024 going? We're almost a month in, full month in. How's everything going?
Well, in my side of the world, which is Asia, it's kind of like we are not totally into 2024 already, because we are about to celebrate Chinese New Year after the New Year, the standard New Year. So it feels like, the year, of course, has started. We are 1 month into 2024, but at the same time, it's kind of feeling like a new beginning again next week. So just getting ready to seize the opportunity of 2024. Markets are moving. There is volatility. Key markets making all-time high. Again, lots of things going on, and ready for the year.
So let me ask you this. In the U.S., you've lived here. We have New Year's resolutions. Does this give you a chance? Do they have that in Asia? And does that give you a chance to restart your New Year's resolutions in case you slipped?
Yes, I think so. I mean, I am not a superstitious person. So in that sense, I'm not so much into it, but definitely with Asian culture and what's happening right now, it's all about wishes and blessings for the new year and things like that. And while I'm not a superstitious person, it's kind of a bit contagious in the sense that you get in this mood of, everything's going to be great and, lots of positivity, and it's pretty cool.
Oh, that's great. That's great. Jim mentioned on our morning show the optimism of the markets. And it's good to hear you saying the same thing where you are. Certainly, you could see it in your face in your chat. So that's great. But for those of you who are watching, thank you for coming. We do have a chat channel, if you will, at ninjatrader.com/events. You can come here and join the chat. And the reason why you might do that is you might ask Jose some questions during the show. If you put some questions in the chat, I'll see them on my internal document and be able to talk to Jose and ask those questions for you. So please come over to ninjatrader.com/events. We'll join the chat. Just press the play button, put in a handle, and you can ask Jose questions as we go through the show. So appreciate that. But for those of people who are new to the show, haven't seen you before, Jose, can you just give a little bit of background on where what's your journey, right, to Traddictiv, your company that you started?
Yeah, I mean, I'm a tech guy, so my background is engineering, telematics, all that kind of things. So technology is kind of like my background. And apart from being in love with technology, there was this one day I fell in love with the markets as well. And in 2008, to be specific, I became a trader. And since then, I have been trading the markets, of course, relying on powerful pieces of technology, such as the NinjaTrader platform. In our company, also, we have developed technologies that we can add to NinjaTrader. And just making myself a mechanical trader through the use of technology and merging two things I love, which is tech and financial markets. So that's kind of like in a nutshell what I do.
Oh, that's great. And what was it in 2008? Well, you're staring kind of down the barrel of the Great Recession, as we call it, the financial crisis. So that must have been, I don't know if it's tough, but that might have certainly been an interesting time to be learning to be a trader.
But to be honest, I feel myself a pretty lucky person in that sense, because when I started discovering the markets, what I had in front of me were fast-moving markets, moving in both directions, especially down. Of course, you had up days too that were very volatile as well in a way. But of course, the main force was going down. And that to me was the normal thing because I didn't know anything before. So, whatever happens next, it's just gonna feel normal. So the only time after '08 where I saw levels of volatility that I didn't see since 2008 was during the pandemic on 2020, on that March 2020. There were levels of volatility that actually surpassed 2008, even though it didn't last for long at all. But yeah, it's a great thing to me as a trader. Again, this is one of the reasons I love technology as well, is because you don't need to have biases, opinions, fears, all those kind of, subjective, human assessments that we all do because we're human. Instead, if you could trade in a way that is totally systematic, where you have this very healthy, carefree state of mind, then you are much likely going to manage your trading emotions and act when you need to act and not to act when you don't need to act, because you just go with the flow with the markets instead of just having beliefs about things that are possibly subjective.
I find your background in tech particularly interesting because it sounds like you've mentioned volatility a couple times here, and volatility is not the easiest thing to grasp when you're coming into the markets, right? We tend to think of trends. We tend to think of, did it go up or down? But I kind of find the engineering aspect of what you did gives you a little bit of an edge in understanding volatility, right? Because in engineering, volatility can be expressed in different ways, right? When we talk about signals, when you're talking about broadcasts, when you're talking about electric resistance, all these different things that different types of engineers have to know for their job. And so it seems to me it's like kind of not a natural step, but certainly a step in the right direction for an engineer coming into trading versus somebody who doesn't have that background.
Yeah, I mean, definitely there is a lot of, just like engineers in the financial industry, there's a lot of mathematical modeling, that's the bread and butter of quants. And, there is a lot of predictive type of models for what volatility may be and things like that. But at the same time, I mean, while those approaches are indeed very powerful and could be extremely useful, the reality is that, there is also something important in trading, at least to me, based on my trading style, which is keeping things simple. It's certainly something powerful to do. And in my case, with the way on how I trade, which has a lot to do with the products that we have developed in the company called UFOs, in the end, it's very simple. And if instead of UFOs, I was to talk about support and resistance, which is probably a term which is more commonly known. So if you got a support and a resistance which are very close to each other, and they are relevant support and resistances, so then just expect little volatility because prices will bounce up and down from those support and resistances. Where if support and resistances are far apart from each other, so expect volatility because there is nothing to stop price from moving in a certain direction until it reaches that support or resistance. So many times, putting on the side that, of course, we can get as complex as we'd like and apply, engineering formulation to financial markets. And indeed, that's powerful to do. We can just look at the charts and with a proper assessment, as long as we are systematic and objective, instead of putting lines on the chart whatever, in a subjective manner, as long as we maintain this systematic approach to assess the market, you can certainly predict incoming volatility that hasn't happened yet, based on where are the next, key price points located at.
So, it's an interesting week that we have you on here, right? There's known news and there's unknown news, and we have a little bit of possibly both, right? We have the Fed announcement and subsequent which we know we have a good prediction of. But then the press conference, we don't know, right? So there could be volatility there. We've got earnings, which again, we have predictions, but then we don't know what the actual earnings are. So there's a little bit of both there. And then, of course, geopolitical risk. We might know what the administrations or the different governing bodies are doing, but then we don't know what's happening on the ground. So a little bit of this mix can introduce that, small volatility if we think we know something's going to happen, or big volatility when something doesn't go as planned. And I think that's why, it's great to have you on this week, because this kind of cuts through that, right? This kind of cuts through all that noise to say, well, we don't necessarily know what's going to happen, but we know where the market might go if something happens.
Yeah, correct. I mean, news, reports, geopolitical events, all of those things are indeed extremely relevant and powerful. And at the same time, depending on how a trader uses that type of information, it could be actually completely useless as well. Let me explain what I mean, because it's kind of like I'm kind of contradicting myself, even though I'm not. So let me explain. So for example, let's say there is something crazy happening I don't want to attract bad luck talking about being superstitious earlier, but let's say there is a new war starting in some country. So obviously this may have an impact in the marketplace, right? But let's say this is happening over the weekend and the market is closed. So there is no order flow coming into the markets because the markets are closed. And even if people are placing orders, they don't get executed because the exchanges are closed. So while something crazy in the form of news and is real is happening out there is no market movement because no orders are being executed or filled, right? Well, of course, now when the market opens, all those orders that have been placed in the market, either to buy or sell as a consequence of let's say a geopolitical event, now they will get filled and now you get market movement. So then the question here at least this is the way I think about it. The question in my mind is, so what did move the market? Those news, those geopolitical events, those earnings reports, is that what moves the market or is the order flow? And to me, the way I think about it is it's actually both, because one is an indirect motivator for orders to be in the market. Without all those things that are happening, such as, for example, an earnings report, you may not have as many intention to either buy or sell a stock or a futures contract. So all those news act as a motivator. And therefore, to me, what's very interesting is to be aware of the timing when those news are going to be released, which is normally public. So you're ready to trade at those times based on the evidence that the market is showing you when the news are reported, because the news may be priced in, and a good news may imply a change of trend and the market crashes, and because it was already priced in, so there is so much profit taking that then the market goes in the opposite direction and so on. So it's not about the news really and the subjective interpretation of it. It's about the timing of the news coming out and then reacting to whatever the market is doing. I think to me that's really the right way, or the powerful way, the non-biased way on how to rely on market information to catch larger volatility moves. Because again, amongst non-educated traders, probably if you use the word volatility, which I'm using a lot today, probably it's a bit scary. Whereas among educated traders, when you use the word volatility, then you have this smile on the face, because volatility is how we get paid. Of course, you want healthy levels of volatility, like, going back to March 2020. So maybe that's just a little bit too spicy, but certainly you want certain level of price movement and some level of speed so you can profit efficiently from the marketplace, And so again, news are, a great motivator for those things to happen. And, we love news.
Well, right. And for new traders, what we like to do is we like to suggest around big news events, be very careful. Be very careful if you do decide to put an order in, or if you're in a position to have your stops in there. And but that doesn't mean you can't participate, right? Maybe the news hits and the market does get a direction. Now it's a matter of, okay, well, I didn't get whipsawed, or I didn't get my face ripped off, as sometimes they say, because it goes the other way. But now, where is this market? Where could it go, right? And we have different ways to look at it. But I think what you've developed is a very informed way of doing that. If that's, I don't know if formed is the best way to describe it, but it certainly is based on evidence from before.
Correct. Yeah, I mean the way I love to play the news is just let the news happen, let the market move, and with that evidence in place, of course, evidence doesn't mean guarantee. We still use stops and contingency measures in case a trade goes against us. But the news happen, so that piece of information goes out. We don't need to interpret that information ourselves, because even if we could interpret the news in a proper way, still, probably the account size of a retail trader doesn't have the power to move a market. So instead, just let's observe the news coming out, observe the initial reaction of the market to that news, and then with that piece of evidence, trade, in a way that is, safer than, just putting yourself in front of the news, kind of like, I don't really like to use the word I'm about to use, but kind of gambling what the news may be, and you are in the trade ahead of the news. That to me is a little bit of a dangerous approach to trading. So I agree with you, Tom, when a moment ago you said be careful there, because yeah, being in front of the news, it's can certainly slap you on the face. The approach, at least my trading style, is about letting the news happen, get that piece of evidence, and then plan a trade accordingly.
Yeah, I totally agree with all of that. Jose, I'm looking at your screen. Maybe Mission Control, we can go over and explain, what you look at during the trading day. And I don't know if we want to start with you've got crude up here. This is a great place too, because with everything happening in the world, crude seems to be sometimes reacting, sometimes not reacting to the news. It's kind of doing its own thing. And again, we don't really care as technicians what the fundamentals are. We just have to know when those fundamental events might happen, right? We've got a couple of reports that come out a week, today, tomorrow for crude. We've got the Baker Hughes rig count on Friday afternoon, not such a great mover. But then the weekend, you mentioned that stuff seems to be happening on the weekend, and we see these crazy moves on Sunday night when the market reopens, that might settle down. So I'd love to see what you're looking at here on the screen.
Yeah, to be honest, my thinking process when assessing a market and getting ready to plan on a trade is kind of like a two-step process, if you wish. So the first thing I am thinking for myself, and I will explain the tools I use and how I do it. But the first, if I was to use, just words to explain it. So the first question I need to answer for myself is, okay, what's the right side of the market to be in? Is it time to be long, or is it time to be short? Is it even time to trade? Okay, because maybe it's not time to trade. Maybe a news is about to be reported, so then I would, stay away for a few minutes. So, so the first question is, should I go long or should I go short? That's the first question I need to answer. So then I could plan a trade accordingly. And of course, in order to answer that question, it's not about flipping a coin. It's about doing some sort of an analysis that gives you an edge. So the way I do this, here on the bottom left of my chart, I am using here in this particular case a 15-minute time frame of crude oil. And what I'm looking is at our tool AutoClimate, which, by the way, is available. People can find it on our website. It's described on the NinjaTrader Ecosystem as well. And this is a free tool, by the way. This tool gives you two indications, red and blue. As you can see, right now is blue, which means that we are in what we call, using our own terminology, we call that an up climate. So what happens with climate? If you think about summer, winter, so a climate tends to last, right? It's not like the summer, randomly changes, from winter to summer. Typically, when you get into a specific climate condition, you remain in that condition for a while. So the moment this is blue, since that particular candle here, so we have a statistical advantage based on the algo being processed by our tool to be a buyer. But that statistical advantage, just like a climate, just like summer or winter, it's going to last, but it's not going to last forever. Just like a trend, if I was to use a trend analogy, trend is your friend. Well, great, trend is your friend until the bend at the end, right? That's the saying. So the question is, when is the bend going to happen, right? And here we got some stats telling us more about it. So for example, from a max distance point of view, and maybe it would be better if I zoom in a little bit, because I'm guessing that maybe it's too small if I don't zoom in. So from a max distance point of view, it says that, a normal thing to happen in an up climate, which is the blue color, is 133. Currently, crude oil has been giving us extensions of 167. This is measured in ATR multiples. Okay, just so you know the unit that we're using here. But it doesn't matter the unit. To be honest, is that 167 is more than 133. So in other words, the market has extended more than what a normal thing is. So in other words, we are now getting into a territory which is statistically unsustainable, because while we are in an up climate, right? So it's been stretching too much. It's like kind of like, maybe a very bad analogy, but it's kind of like, you are in the rainy season and it's been raining way too much. So odds are it's going to stop raining, that kind of thing. Even though it's probably not the ideal analogy, right? And then from a count point of view, which is what we have on the right, count, another way to think about it is duration. So apart from extension, we're also thinking about duration. What is the normal duration of a summer? What is the normal duration of a winter, right? So in this case, statistics suggest that 5 is a normal thing to happen, where currently we've reached 7. 7 again is more than 5. So what does that mean? That, well, crude oil, is showing us here this incredible, beautiful, powerful move to the upside, but statistically speaking, that is now entering the territory of non-sustainable. So if we had met 1 hour, 2 hours ago, and I'm using 1 or 2 hours ago because the chart I got on the bottom left is a 15-minute time frame. So if we had met 4, 5, 6, 7 candles ago, which is 1 hour and a half ago, so then we would be in a blue climate, and some of these moves to the upside, just like buying here, for example, could have been a relatively reasonable trade to plan, and maybe even relatively easy to trade to execute. But now it's too late, right? Even though we still have a blue dot, we have now indication that tells us that statistically this climate may be ready to reverse, because it's been lasting for too long and it's been overstretching, right? So that's the first thing I do in my mind, is to do the assessment of where are we in the climate. So I know if it's time for me to plan on long trades or plan on short trades.
So Jose, real quick, just for a little bit of definition, ATR, we throw that term around, stands for average true range. So it's taking the, there's a look back period, maybe it's 14, maybe it's 20, whatever it is. And it's looking at the average true range of a bar, which is really either the range from the high to low, or if there's a gap, we consider the previous close as part of that range. And so because the market did travel that distance from one bar to the next, so you have this average, what does it average trade on an average day in terms of high to low? And we use that, Jose, in our morning shows as a target. As the trading day goes on, what are our reasonable targets if it's an average day? This is, really smart way to do this too. Right now, the actual, for this 15-minute chart, the average trading range is, or the current average trading range is the current range is 1.67 more than the average, right? Which is, consider it thinking of like overbought or overextended. And if you believe in mean reversion, there's going to be a little bit of a comeback there.
Correct. That's the concept. I mean, the idea is to trade market conditions which are, I'm going to use the word reasonable, because if you trade something that is behaving reasonably well, so it's more predictable. It's just like, again, maybe another not ideal analogy, but it's like, let's say you are a business owner, you're going to hire an employee. So you want a crazy guy, or you want someone who behaves in a way that is predictable. So again, maybe not the best analogy, but you get my point. So when dealing with a market, you want to assess, is the market at this moment in time behaving reasonably well, and therefore is more predictable, so let's plan on a trade? Or is the market going crazy and it's kind of like a nuts period, and therefore you're just taking a gamble trade here? So that's, again, can you do that? I mean, we're all adults here. I guess that anyone can do whichever they choose to do. But if our goal is to create consistency in results, I mean, obviously, dealing with something that is more predictable is probably, is a better decision, isn't it?
Yeah,
so,
for sure.
So this is step one, right? And once you know which side of the market to be in, long or short. And again, I use auto climate. Maybe other traders listening, they are trading, I don't know, up channels or down channels, or you name it. There are many ways on how to assess the market, which could be totally correct. I'm just sharing my style here. And so once you know if it's time to be long or to be short based on your methodology, then the next question is, okay, so now, second question, which is my two-step process, is, okay, so what's my entry and my exit? What are my triggering prices for the trade? That's it, right? And to do that, again, there are many ways on how to do it. So if we're talking about, Fibonacci traders in the world, so maybe they draw their retracements and extension lines, and those are going to be their entries and the exits. We're talking about classical technical analysis with classical support or resistance lines. Definitely a valid way to approach it as well. In my case, I'm dealing with the UFOs, which even though I haven't explained it, I'm guessing that for the ones listening to us and watching the screen, so they are guessing that these flying saucers, these round flying saucers, are the UFOs, which is an acronym that stands for on-field order. So on-field order, when it's green, like the one I'm pointing at here, that means buy on-field orders. And when it's red, like the one here on the right side of the screen, so that is sell on-field orders. So basically, you want to buy in the green, sell in the red, or short in the red and buy to cover or close the trade in the green. And that, make it compatible with the market condition. So right now, the market condition with crude oil, it's not favorable to go long because, as we said, the market is probably unsustainable to the long side. So, but it's still a blue climate. So I would be just waiting for price to rally back up to that red UFO, and I would be ready to short, expecting, a reversal. And, that would be a bit aggressive because if you wish that the trend is still up, so that would put me in the position of being a bit of a counter trend trader, which again, it's all about trading styles. And to some traders may not be the way to do it. For other traders, a bit more aggressive, it's okay. And but the concept, which is what I'm trying to share here, is this: two steps. First, assess the market condition, and second, define entries and exit compatible with the market condition you decided to trade, instead of just buy and sell while you don't know if it's time to go long or time to go short, which is a risky position to be in because often it leads to being stopped out very quickly. Mm-hmm. And for those traders listening, that at least based on my experience, for those traders listening out there, that they too often suffer situations where they enter a trade and immediately they get stopped out, meaning that the time to get to the target is a long time, but getting stopped out happens immediately. This is typically the sign of being on the wrong side of the market. So you are fighting an impulse, you are fighting a trend, you're just trading in the wrong direction at this moment in time. So that's why my step one is to try to determine that from a statistical point of view, so then I can position myself ideally, with more odds.
So right now, if we're I'm looking at your, what is that? Your chart. It's on the right-hand side of the screen, just to the right of the Superdome. It could be either one, but that one right there. So that buy UFO at 77.76, 77.66, we're trading in that level right now. That is a possibility. If you're a shorter term trader, you could say, well, you know what? I see a target up at the top. That's at 77.95 to 78.06. If we get back down to this green UFO, it might be worth going long there to get that shorter term trade, even though you're kind of at the top of the trend. I mean, you're probably not even, well, maybe you're at the 23% retracement level on a Fibonacci, but now see, that just changed. That's interesting, right? So now this is saying that, well, wait a minute, maybe those unfilled orders have been filled now, and it's flipped. I didn't plan that. There's no way I could have planned it, but there is an example of where your levels do change based on those orders that get filled versus not getting filled.
You're correct. And that, to be honest, it was just a coincidence, but it was a fantastic coincidence from an educational point of view. I mean, we can see now real time how the expectation of an unsustainable market condition going up too far, too fast, for too long was likely going to change to the downside. And we can now see the evidence of on-field orders coming in. Let's say, coming back to our prior conversation a moment ago about news, which is not the case, but let's say that, 10 minutes ago, a news was reported, and now you get to see those two red UFOs coming in. So that is the evidence I was referring to earlier that is telling me, okay, well, the news is out, so the timing is relevant in the sense that you will have traders trading the news. And those traders are shorting. And it's not only because the market went down a little bit, it's because you get two red UFOs there. Those red UFOs, again, based on our technology, those are it's a piece of technology identifying on-field orders in the market, and it's happening real time as we saw. So now the evidence is there, and therefore, if you are an aggressive trader, you can just, there is profit margin from the current price, which is 77.72 all the way to 77.34. There is, a pretty okay profit margin, so you may want to go short right now. With my style of trading, I would rather wait for price to rally inside the red and hit 77.74. I would prefer for the market to rally just a little extra, get to 77.74, because then I would be selling exactly where the sell orders are. That's it. This is when I would enter short on a trade, and my target now would be 77.34 below. So my stop would be above 77.90, and my target 77.34. So basically, I would be risking the size of the red UFO in exchange to make a profit, which is the white zone between the red and the green, which is kind of like, visually speaking, let's call it a 3-to-1, maybe a little less than 3-to-1, something like that.
No, that's great. And these tools you can overlay with other tools, right? So I'm looking at this, and just from what I know, order flow, volume profile, there might be what we call a volume gap between those UFOs, right? Maybe not exactly, maybe the volume gap, but less volume traded because it didn't spend a lot of time there, right? It didn't like consolidate in there. It just kind of, you had a little bit of a pullback around 77.60 to 77.50. But if you were to overlay order flow volume profile, you might see something that gives you, oh, well, it makes sense if we fail at 77.74 to continue up, because there were sell orders are coming in, and then the next buy orders that we were unfilled on were down at 34.18. It's going to be reflected in the volume. You might throw VWAP in there. These are tools that you wouldn't use in a vacuum that might really nicely complement your other indicators you use.
Yeah, we can see now that plenty of selling has taken place at this moment in time. And unfortunately, the sell on field orders that were assessed, they are not on the screen anymore, which is now removing odds in the favor of the trade. Even though there is another UFO higher, we may need to see crude oil rally before it crashes. But again, so this is now when trade management may apply. A trader may now decide to just exit the trade at break even, so no profit, no loss, and that's it. Other traders may decide to close half of the position and leave the remaining open, etc. But to be honest, one of the things that was against this trade, which I didn't mention, is the fact that you see that horizontal line here. This is actually an average. And we can see how the average is, and that's why I have this horizontal line plotted on the screen. The beauty of Ninja is that you could actually plot averages, which typically follow price, but you can actually plot them as horizontal lines, which I really like that. And we can see how a turning point took place right there at the average. So plenty of algo trading systems that buy and sell based on averages are, bringing price back up from there. So that was not the ideal entry, to be honest, because the average was a bit too close. And the reason why is because we're still in a blue climate. So we can see here how we're still in a blue climate. If I go back to the bottom left part of my screen, so waiting another 11 minutes until we got a new 15-minute candle, which probably will show a red dot, would have been more advisable, because that means that we will be now on the other side of the moving average, and probably that little barrier, which is probably a temporary barrier on the way down, would not be there.
What is that average? Is it a moving average? Is it VWAP? What is it?
It's just a simple 9 EMA, nothing magic. 9 EMA calculated on the 15-minute time frame is that same EMA I got here on the 15-minute time frame. I'm just freezing the screen now. That EMA is pointing at 77.65 on the 15-minute time frame. Down on the left, notice how on the top 77.65, 77.65, and 77.65. So this is a 2-minute time frame. This is a volume chart with 610 contracts per bar. And this is a tick chart with 377 ticks per bar. So all those timeframes are also plotting. Again, my screen is frozen, so I can do the drawing. So all those timeframes are plotting that same average from the 15-minute timeframe. Why 15? Because that's the timeframe I use to assess the climate.
Right.
So if there is any barrier, I want to plot it on the lower timeframes, which are the ones I use for entries and exits. I want to plot it, and I do it, by adding, two sets of data series on the chart. So each chart, let me show that. So we got two data series. One is the 15-minute time frame, and the other one is this, in this case, 610 volume bars. And therefore, that horizontal line is simply the EMA coming from the 15-minute time frame, plotted on the 610 volume chart as a horizontal line.
That's pretty complex, but it's really cool that you could do that, right? Because
it's very cool.
What I'm seeing is based on the different charts, you have different UFO levels, just because of how you slice and dice the price data, right? You've got a fixed 2 minutes, you've got 610 volumes, which might be similar to 2 minutes, it might be 3, it might be 1, but it looks like it's actually probably reflecting more of a 3-minute chart, something like that. And then you've got the tick chart, which is very similar. And they all have these, kind of in the same area, but not quite in the same area, just because the data is sliced a little differently.
Correct. And this is done on purpose. So, we've calculated what we call equivalencies, which basically is, kind of like taking volume charts and tick charts to be as equivalent as possible to the 2-minute time frame, which is the one I have on the left. You guessed it right when you said 3. It's actually 2. You were close enough. And so we created these equivalencies. So that way, basically we are looking at the same thing from different angles. It's kind of like, again, love analogies, not always the best ones, but I do love analogies. It's kind of like, let's say you're a doctor and you need to look at a patient, X-ray. Typically, doctors would not take only one picture. They would take multiple pictures, different angles, etc., so they can have a proper assessment. So here's the same thing. I am willing to look at the 2-minute time frame compared to the 15. That's what I'm willing to do. But the time, time is great, but at the same time, the 2-minute time frame at 4 a.m. versus the 2-minute time frame at 10 a.m.
Very different.
The relevance of the data has nothing to do, right?
Right.
So what we've done is we've calculated those equivalencies. So now I can plot volume timeframes and tick timeframes, which are equivalent to the 2 minutes. So that way I am kind of compatible with my climate calculated on the 15-minute time frame. But I am looking at the markets from different angles, and notice how these timeframes will pick up information that the 2-minute will not. For example, that red UFO is there and is here.
Right.
77.95 is the same. 08.06 almost the same, but then the 2-minute time frame, it doesn't even show. Right. And so if you were to use timeframes only based on time only, you would miss on that information. And again, that's another beauty of Ninja. Not all trading platforms, absolutely, actually very few trading platforms have volume and tick charts, and that's a very professional approach to understanding or reading a chart beyond the classical timeframes based on time.
Well, right, and that's a very good point. And the reasons, the more evidence, the better, I think, right? You've got one chart also picking up that green UFO at 77.64. We saw that before I think on the 610 volume, and it disappeared. But it is going back to this data is sliced differently. So when we look at those levels that the 377 tick chart catches, it's because it's looking back and at the same levels. There might be more evidence that there were unfilled orders based on those ticks rather than based on the volume or the minutes.
Correct.
I love it.
Correct. So yeah, so in the end, the idea is just to rely on market data and just act based on what you see instead of, a guess or a biased prediction. Instead, just go with the flow. Let the platform to give you what's happening and react to that with risk management. Always your stops, always your size properly calculated so you don't over position yourself and things like that. And that's it. And discipline, control of emotions, and repeat.
So, Jose, can we look at the E-mini S&P, because we focused a lot, or the NASDAQ, one of the two. I mean, we focus on those two markets today a little bit closer. So our viewers might have the experience of this morning and you know what happened this morning and put it into their own kind of data banks, if you will. So we've got
so here, for example, with the S&P, if we start with the bottom left, we can see that we actually have a pretty ideal market condition here because we have just started a down climate. So we just got the first dot. The statistical duration of a down climate is 4. The number 4 here in red color, where we are currently in this climate for one candle, one dot. So it's the beginning of a climate, right? So we just started winter, and winter tend to last, right? So we are, I am now ready to be a short trader, for a matter of, 1 hour, because 4 times 15 minutes is 1 hour. From an extension point of view, the maximum extension we've got based on the ATR is 0.81. A normal thing to happen in this time frame is 1 full ATR. We have not reached 1 full ATR, so which means that even though we have a pretty large bar here, it's not significant enough to, call this too far, too fast, unsustainable. It's not. So I am willing to go short. And now for me to go short, and here I have a great setup. So if I look at the 2-minute time from here, for example, I'm zooming in. So this is the type of setup I like the most, where I do have a UFO up here, but notice how this UFO is actually lining up with the EMA. This is something I appreciate very much, because when we saw earlier that those EMAs can be significant to generate initial bounces, initial turning points. So I am lining up now an EMA together with a UFO, and therefore, based on our technology, we have on-field orders to sell here. So getting short at 49.25 makes sense, with a stop above 53. That makes sense. But on top of that, I have a little bit of extra odds here because an EMA is also lining up with the UFO. So in this case, I got 2 forces that potentially may help the trade. Apart from the climate is down. So if this market rallies to this price, it's likely going to react to this average and the on-field orders located right on the other side of the average. I mean, how many times, and this is a question for the listener, so how many times you guys have looked at the market and you see price go just a little bit beyond an average and bounces and keeps going, right? So that's exactly the setup. So here's the EMA and you have on-field orders on the other side. So classical setup where, price comes into the red UFO, turns, starts moving down, and then all the algo system that trade based on moving averages that will realize the moving average is acting as what it's supposed to be, and then a lot of extra selling is coming in after the fact. So that's going to help very much with the trade setup for the trade then to continue, and that climate to continue expanding to the downside. On top of that, if we look at the tick charts, we can also see that on the tick charts, we can also see the same setup with the EMA and the UFOs. So that kind of setup is really what I appreciate the most, in the sense that I'm lining up multiple forces in my favor. This is part of my filtering process, because we have many on-field orders in the market. We have many UFOs. Sometimes, if the markets are volatile, you have many UFOs up and down. And the question is, which one are you going to trade? And one answer could be, well, whichever are far enough, so you have a good relationship between risk and reward. And then you can just trade UFOs and that's it. But if you want to be a little bit more sophisticated, you can now, as you said yourself, Tom, you can combine the UFOs with other things. For example, a moving average, like I'm mentioning now, or maybe a Fibonacci retracement line, or maybe volume profile. And now, next thing you know, you have multiple tools working in your favor, which still not a guarantee in trading. That's why we always use stops and protect our risk. But whatever adds odds in your favor, I guess, is to be welcome. And that's my philosophy when I trade.
Oh, that's great. That's great. And I noticed, on your tick chart kind of encompasses, right now at least, all elements to some degree of the other 2 charts, right? Whereas the 2-minute chart doesn't have the green UFO, but the volume chart does. Volume chart has a really wide UFO at the top, whereas it's split up, and it's split up even further in the tick. Do you find that you look at one primarily over the other two, or is it you're looking at all three and just kind of coming up with, well, that makes sense, that makes sense, that makes sense, so I'm going to be wary of all those UFOs?
So when I am looking for entries, I look at whichever time frame gives me an entry. But then when
Okay.
I'm thinking of my stop, then I will look at what's the worst case scenario.
Okay.
And the worst case scenario in this case, if you think about it, is so if your entry is 49 and that UFO ends at 50, but that UFO is basically overlapping the other UFO that ends at 53, and 53 is inside this guy between 50 and 55. So guess what? My stop is going to be 55.75 because that's the worst case scenario.
Got it.
So again, for the entry, I'm just going to use whatever UFO, whatever it is, from right to left in whichever of my charts, as long as I have this situation where a UFO envelopes an EMA, that's going to be enough for me to be happy to take a trade. But then when it comes to setting my stop, I will look at the worst case scenario across timeframes.
Got it. Got it. No, that's really fascinating. You know, Jose, unfortunately, we're up against time. This time with you goes by real quick. And you know, I have a feeling we could be speaking about so much more. But if viewers want to learn more about what you're doing, where can they go to find you?
Yes. So, I mean, we talked about trading with UFOs, and our website, actually, as you can see here, maybe I'll zoom in one more time. Our website is tradewithufos.com. So I welcome everyone to go take a look to our website. There are many tools, but basically all the tools fall into two categories: either apps, which is our trading technologies. For example, this is where you go to get the UFOs on NinjaTrader. You would just click on apps and follow the steps. Or also training, where we have futures courses and other courses, trading psychology, backtesting, a collection of courses there that could also help to master how to trade for the ones of you that may need that, or want to refresh or take things to the next level as well. So that's where to find us. And then if there is any trading question, so going all the way to the bottom part of our website, there is a Q&A forum where there are plenty of questions and answers already there. Anyone could type questions, and our support team will provide answers. We have a chat GPT, which is customized with the stuff that we do, so people can come in here and ask trading questions related to UFOs, and this particular GPT will answer as well, which is a great way to get instant responses. And for sure, I'll type it on the screen, my email address. Anyone who has further questions and would like to talk to me, more than happy, actually. Very passionate about this, like you, Tom. So we can talk about this forever, as you said. So anyone who has a trading question, just need to shoot me an email, and I'll be more than happy to send an answer. I'm happy to help.
That's great. Jose, thank you so much for this great information. It's always a pleasure to talk with you and have you back on Traders Workshop. And we'll be doing that this year. Year of the Dragon, right?
Here we go. Yes, it is.
Well, you're dressed like a dragon. It's a good year, right? It's a good luck year, right? In the year of the Chinese New Year.
Yes. For the people out there celebrating Chinese New Year, Sinin Kuala. And definitely many families will be very, very happy if they happen to have babies coming into this world this year of the dragon. It's from a culture point of view, is a very big thing here in this side of the world.
Awesome. Well, thanks again for joining us on Traders Workshop, and we'll see you again, hopefully real soon. But again, want to extend my thanks to you and everything you do. For our viewers, this is not the last show today. We have one more show. In fact, it's been confirmed. Mike Burke, I think, Jose, you know Mike.
Indeed.
Yeah, Mike Burke will be finishing the day with bars closing. So I hope you can come back and watch his expert analysis. In the meantime, though, I want to wish everybody have a great trading day, and we'll see you later.